In 1933, the United States government made it illegal for American citizens to own gold. Executive Order 6102 required all citizens to surrender their gold coins, bullion, and certificates to the Federal Reserve at $20.67 per ounce under threat of fine and imprisonment. Once the gold was collected, the government revalued it to $35 per ounce, an instant 69% devaluation of the dollar. The population was forced to exchange real money for paper promises, then watched as those promises lost nearly half their value overnight. Today, in 2026, central banks are buying gold at the fastest pace in 50 years, while simultaneously telling their populations that gold is a barbarous relic with no place in modern finance. In 2023 alone, central banks purchased over 1,000 metric tons of gold, the second highest annual total on record. Why are the institutions that create money buying the asset they claim is obsolete, when those who control currency systems begin hoarding the very asset they replaced currency with? What does that signal about their confidence in the system they're managing? For thousands of years, money was limited by nature. Gold and silver could not be printed, decreed into existence, or created through accounting entries. They had to be mined, refined, and minted. This physical limitation was not a weakness of the monetary system. It was the foundation of it. Scarcity created value. Value enabled trade. Trade built civilizations. The Roman aureus, first minted under Julius Caesar in 46 BC, contained roughly 8 grams of gold. For nearly 3 centuries, this standard remained relatively stable. A Roman soldier could expect consistent purchasing power from his wages. Merchants could plan long-distance trade knowing the money they received would hold value. The limitation of gold supply forced fiscal discipline on the empire. Spending could not exceed the gold available to back it. But empires have needs that exceed their revenues. Wars must be funded. Populations must be placated. Infrastructure must be maintained. When Emperor Nero began debasing the aureus in 64 AD by reducing its gold content, he was not making a monetary policy decision. He was making a survival decision. The empire needed more money than it had gold to back, so the gold content was reduced from 8 grams to 7.3 grams, then to 6.5 grams. By the time of Emperor Constantine in the early 4th century, the aureus had been replaced by the solidus, which stabilized at 4.5 grams of gold, nearly half the original standard. This progression took over 250 years. The debasement was gradual enough that no single generation experienced catastrophic currency collapse. But the cumulative effect was undeniable. Prices rose. Trade became difficult. Soldiers demanded payment in untainted gold rather than debased coins. The wealthy hoarded precious metals while the poor suffered from inflation. The monetary foundation of the empire eroded slowly, then catastrophically. The critical pattern is this. The decision to debase was always framed as temporary, an emergency measure to address immediate needs. Yet once debasement began, it never reversed. Each crisis justified further debasement. Each debasement created conditions requiring more debasement. The cycle was self-reinforcing and irreversible without political collapse or military defeat forcing a reset. China faced the same progression 1,000 years later. The Song Dynasty, ruling from 960 to 1279 AD, introduced the world's first government-issued paper currency, jiaozi, around 1023 AD. Initially, the paper notes were backed by reserves of copper, silver, and gold. Merchants could redeem notes for metal at fixed rates. The system worked because the paper represented a claim on something real. But paper money introduced a temptation that metallic money did not. It could be printed far faster than metals could be mined. As the Song Dynasty faced military pressure from northern invaders, expenses soared. Rather than raise taxes or reduce spending, the government printed more jiaozi. By the 1100s, inflation had become severe. The government attempted price controls, which failed. They issued new currency to replace the old, which only accelerated the loss of confidence. By the time the Song Dynasty fell to the Mongols in 1279, its currency was worthless despite government decrees insisting it held value. The Mongol Yuan dynasty that followed made the same mistake. Kublai Khan issued paper currency backed by silver reserves, which worked initially, but as the Mongol Empire expanded and costs increased, the printing accelerated. By the mid-1300s, hyperinflation had destroyed the currency. Marco Polo observed this system during his travels and noted that the Khan could create money at will, a power that seemed miraculous to Europeans, still using metal coins. What Polo didn't witness was the eventual collapse that followed this unlimited money creation. These historical examples share a common structure. Currency systems based on precious metals imposed natural constraints. Those constraints forced fiscal discipline. When empires circumvented those constraints through debasement or paper substitutes, they gained short-term flexibility at the cost of long-term stability. And in every case, the long-term cost exceeded the short-term benefit. The modern fiat currency system was not designed as an ideal monetary architecture. It emerged from the wreckage of the gold standard through a series of forced compromises, each justified by immediate crises, none reversed when the crises passed. The classical gold standard, which operated from roughly 1880 to 1914, represented the peak of metallic-backed currency systems. Major currencies were convertible to gold at fixed rates. The British pound was backed by gold. The US dollar was backed by gold. The French franc, German mark, and Japanese yen were all backed by gold. This created a unified global monetary system where exchange rates were stable and predictable because they were all derivatives of the same underlying asset. World War I shattered this system. The cost of the war exceeded every participating nation's gold reserves many times over. To fund the conflict, governments suspended gold convertibility and printed currency. The British pound, which had been convertible to gold for over 200 years, was taken off the gold standard in 1919. Other nations followed. What was presented as a temporary wartime measure became a permanent structural change. The 1920s saw attempts to restore a modified gold standard. Britain returned to gold in 1925 at the pre-war exchange rate, a decision that Winston Churchill later called the greatest mistake of his life. The rate overvalued the pound, making British exports uncompetitive and contributing to economic stagnation. When the Great Depression began in 1929, nations abandoned gold convertibility one by one to pursue independent monetary policies. Britain left gold again in 1931. The United States severed the link between the dollar and gold for domestic citizens in 1933, though international convertibility remained. By the end of World War II, the global monetary system needed reconstruction. Most currencies were inconvertible. Trade was conducted through bilateral agreements and barter. The Bretton Woods Conference in 1944 created a new system. The US dollar would be convertible to gold at 35 per ounce, and all other currencies would peg to the dollar. This made the dollar the world's reserve currency, but it also made the United States the guarantor of the system's stability. The Bretton Woods system worked as long as the United States maintained discipline. Other nations held dollars as reserves because those dollars could be exchanged for gold. But this created a structural problem known as the Triffin dilemma, identified by economist Robert Triffin in 1960. For the system to function, the world needed an ever-increasing supply of dollars to facilitate growing trade. But increasing the supply of dollars meant issuing more claims on a fixed gold reserve, eventually making the promise of convertibility unsustainable. By the 1960s, this contradiction was becoming acute. The United States was running persistent trade deficits. Dollars were flowing overseas to pay for imports, military bases, and the Vietnam War. Foreign central banks accumulated these dollars and increasingly began exchanging them for gold. U.S. gold reserves fell from over 20,000 metric tons in 1950 to under 10,000 metric tons by 1970. At the rate of drainage, full convertibility could not be maintained. President Charles de Gaulle of France understood this. Starting in 1965, France began systematically exchanging dollars for gold, draining U.S. reserves. De Gaulle publicly questioned why France should hold depreciating paper dollars when it could hold gold instead. Other nations, seeing France's example, began doing the same. By 1971, the gold drain had become unsustainable. On August 15, 1971, President Richard Nixon announced the temporary closure of the gold window. The dollar would no longer be convertible to gold, even for foreign central banks. This was framed as a short-term measure to stop speculation. It became permanent. For the first time in history, the entire global monetary system was based on fiat currency. Money backed by nothing except a government decree and the willingness of others to accept it. The immediate aftermath was chaos. Currencies floated against each other. Exchange rates became volatile. Inflation, which had averaged 2.5% in the United States during the 1960s, accelerated to 7.1% in 1974 and peaked at 13.5% in 1980. Gold, freed from the $35 peg, soared to over $800 per ounce by 1980. Oil prices quadrupled during the 1973 oil crisis, partly because OPEC nations recognized that they were being paid in depreciating dollars. What emerged from this chaos was not a return to gold, but a new system based on central bank management. The theory was that without gold constraints, central banks could stabilize economies by adjusting interest rates and money supply to match economic conditions. Inflation could be controlled through credible commitment to price stability. Currency stability could be maintained through market confidence rather than metal backing. This system has now been in place for over 50 years. It is the longest period in modern history that major currencies have operated without commodity backing, and it is an experiment without historical precedent for success. When money is no longer constrained by physical reserves, the only limit on its creation is political will. And political will, when faced with crises, recessions, or electoral pressures, consistently chooses expansion over restraint. In 1971, when the gold window closed, total U.S. federal debt was $398 billion. U.S. GDP was approximately $1.16 trillion. The debt to GDP ratio was 34%. By the year 2000, federal debt had grown to $5.6 trillion, against a GDP of $10.2 trillion. a debt-to-GDP ratio of 55%. By 2020, debt exceeded $27 trillion with GDP at $21 trillion, a ratio of 129%. As of 2026, federal debt stands above $36 trillion against a GDP of roughly $28 trillion, a ratio of 129% that would be far higher if not for inflation artificially boosting the nominal GDP figure. This is not a partisan observation. Debt has increased under every administration, regardless of political party, since the gold standard ended. The removal of the gold constraint removed the mechanism that forced fiscal discipline. Without a hard limit, spending became a function of political priority rather than economic capacity. The money supply tells the same story. In 1971, M2 money supply, which includes cash, checking deposits, and easily convertible near money, totaled approximately $600 billion. By 2000, M2 had grown to $4.6 trillion. By January 2020, it reached $15.5 trillion. Then came the pandemic response. By April 2022, M2 peaked at $21.7 trillion, a 40% increase in just over 2 years. It has since contracted slightly to around $21 trillion, but remains nearly 36 times larger than it was when fiat currency became the global standard. This expansion has not been matched by corresponding growth in productive capacity. Real GDP growth has averaged approximately 2.5% annually since 1971. Money supply growth has averaged over 7% annually. The difference between those two numbers represents the inflationary pressure built into the system. Inflation that has been partially absorbed by asset price increases, partially exported to other countries holding dollars, and partially suppressed through financial engineering and accounting changes. Gold's price reflects this monetary expansion with remarkable precision. In 1971, gold traded at $35 per ounce under the official peg. By 1980, it had reached $850, a 2,400% increase. It then entered a 20-year bear market as central banks sold reserves and financial markets absorbed excess liquidity. Gold bottomed around $250 in 1999. Since then, it has risen to over $2,000 per ounce as of late 2025. Measured in constant dollars, gold has roughly maintained its purchasing power over the past century. Measured in fiat currency units, its price has exploded because the currency has been debased. Silver shows similar patterns with greater volatility due to its industrial uses. In 1971, silver traded around $150 per ounce. It spiked to over $50 in 1980 during the Hunt brothers' attempt to corner the market, then collapsed. It spent 2 decades below $10, occasionally dipping below $5. Since 2000, it has trended higher, reaching $49 in 2011 before declining again. As of late 2025, silver trades in the mid-20s range. But the more significant signal is not price, it's the physical supply situation. The COMEX, the primary U.S. exchange for silver futures, held over 350 million ounces of silver in registered inventory as recently as 2020. By late 2025, registered silver has fallen below 40 million ounces, a decline of nearly 90%. Total COMEX silver inventories, including eligible but not registered stocks, have fallen from over 400 million ounces to under 250 million ounces. This is occurring while industrial silver demand, driven by solar panels, electric vehicles, and electronics, is rising 15 to 20% annually. The gap between supply and demand is being met by above-ground stockpiles accumulated over decades, but those stockpiles are finite and depleting. At current rates of demand growth, visible inventories will reach critically low levels within the next several years. This creates a situation where the paper silver market, futures contracts traded on exchanges, vastly exceeds the physical silver available for delivery. Estimates suggest that paper claims on silver exceed physical supplies by ratios of 100.1 or higher. Central bank reserve composition has also shifted in ways that signal declining dollar confidence despite the dollar's apparent strength. In 2000, approximately 71% of global central bank reserves were held in US dollars. By 2020, that had declined to 59%. As of 2024, dollar reserves have fallen to approximately 58% of global reserves. That may seem like a modest decline, but in absolute terms, it represents trillions of dollars of diversification away from the world's reserve currency. Gold reserves held by central banks have increased for 14 consecutive years through 2025. Total official gold holdings now exceed 36,000 metric tons. China, Russia, India, Turkey, and Poland have been particularly aggressive buyers. China's official gold reserves have grown from 600 tons in 2000 to over 2,200 tons as of 2024. Though many analysts believe China's actual holdings are significantly higher given its domestic mining production and lack of gold exports. The yield curve, The difference between short-term and long-term interest rates has inverted multiple times since 2022, a pattern that has preceded every recession since World War II. As of late 2025, the curve has steepened again, but long-term rates remain elevated despite Federal Reserve rate cuts. The 10-year Treasury yield sits above 4.5%, while the Fed funds rate has been reduced to the 4 to 4.25% range. This suggests bond markets are pricing in either persistent inflation expectations or increasing credit risk for U.S. sovereign debt, neither of which would have been conceivable under a gold standard. Corporate debt has reached $11 trillion in the United States, up from approximately $3 trillion in 2000. Much of this debt was issued at near zero interest rates between 2010 and 2021. As this debt matures and must be refinanced at current rates of 7 to 10%, a wave of defaults is mathematically inevitable unless rates fall dramatically or profits surge unexpectedly. Neither seems probable, given current economic conditions. Real estate provides another data point. The median U.S. home price in 1971 was approximately $25,000. As of 2025, it exceeds $400,000, a 1,500% increase. Median household income over the same period grew from roughly $9,000 to $75,000, an 800% increase. Housing has outpaced income by nearly 2.1, making homeownership increasingly unattainable for younger generations. This divergence is a direct consequence of monetary expansion flowing into asset prices, while wages remain constrained by competitive labor markets. Markets do not speak in sentences. They speak in patterns, anomalies, and divergences that reveal stress beneath the surface. What the markets are saying now, if interpreted correctly, is that confidence in the fiat currency system is eroding among those who understand it best. The first signal is the divergence between gold's price and real interest rates. Traditionally, gold performs poorly when real interest rates, nominal rates minus inflation, are positive and high. Holding gold means giving up the yield available on bonds. But since 2022, even as real rates have risen above 2%, the highest in over a decade, gold has not declined. Instead, it has reached all-time highs above $2,700 per ounce in October 2024 before stabilizing in the $2,000 to $2,100 range in late 2025. This behavior contradicts conventional models. It suggests that buyers of gold are not making decisions based on opportunity cost calculations. They are making decisions based on systemic risk assessment. The buyers are central banks, sovereign wealth funds, and high net worth individuals who have access to information and analysis unavailable to retail investors. Their continued accumulation, despite negative carry costs, signals a belief that the risk of holding fiat currency reserves exceeds the cost of holding non-yielding gold. Silver's signal is different but complementary. Now, while gold is primarily monetary, silver is industrial. Approximately 50% of silver demand comes from industrial applications: solar panels, electronics, batteries, and medical equipment. This industrial demand is inelastic. Solar panel manufacturers cannot substitute another metal for silver without redesigning their entire production process. Electric vehicle producers cannot eliminate silver from their electronics without significant engineering changes. As industrial demand has surged, silver mining production has stagnated. Global silver mine production peaked in 2016 at approximately 900 million ounces and has since declined to around 850 million ounces annually. Total silver demand, including industrial, investment, jewelry, and silverware, now exceeds 1.1 billion ounces annually. The gap is being filled by recycling and drawdowns of above-ground inventories, but recycling cannot scale infinitely. Much industrial silver is used in applications where recovery is impractical or impossible. Solar panels contain silver in such small quantities per unit that recycling is not economically viable at current prices. As these panels reach end of life in 20 to 30 years, that silver is lost to the supply chain. This creates a structural deficit that will eventually force either dramatic price increases or substitution, and substitution requires years of research and retooling. The silver market is signaling this through the inventory drawdowns mentioned earlier. When registered COMEX inventories fall 90% in 5 years, while demand is rising, it indicates that physical silver is being removed from the paper trading system, and either consumed industrially or held privately. This tightening of physical supply creates conditions for repricing events where paper and physical markets disconnect. Currency markets are sending signals through volatility and intervention frequency. The Japanese yen has weakened from 110 to the dollar in 2021 to over 150 to the dollar in late 2024, before partially recovering to the 145 range in 2025. The Bank of Japan has intervened repeatedly to slow this decline, spending an estimated $60 billion on interventions in 2024 alone. These interventions have produced only temporary effects, suggesting that market forces are overwhelming policy intentions. The British pound experienced a crisis in September 2022 when poorly conceived fiscal policies triggered a bond market revolt. Emerging market currencies have experienced even greater stress. The Turkish lira has lost over 80% of its value against the dollar since 2018. The Argentine peso has collapsed repeatedly despite multiple currency redenominations. The Lebanese pound has lost over 95% of its value since 2019. These are not isolated failures. They are examples of what happens when fiat currency systems are pushed beyond their credibility limits. Credit markets are signaling stress through widening spreads and bifurcating access. Investment-grade corporate debt remains accessible, but at spreads significantly wider than the 2021 lows. High-yield spreads have blown out to over 500 basis points above treasuries for lower-rated issuers. Covenant quality has deteriorated as lenders demand less protection, a sign of reaching for yield in a capital-scarce environment. Leveraged loan markets have seen a surge in distressed exchanges and amendments as borrowers struggle with higher rates. Private credit markets, which grew explosively during the low-rate era, are experiencing their first real stress test. Default rates in private credit are not publicly reported with the same rigor as public markets, but anecdotal evidence suggests significant problems emerging in portfolios of loans made to highly leveraged middle-market companies. The repo market continues to require standing facilities from the Federal Reserve to function smoothly. In a healthy market, banks with excess reserves lend overnight to banks that need short-term funding without requiring central bank intermediation. The persistence of repo volatility and the need for backstops indicates that trust between counterparties remains impaired more than 15 years after the 2008 crisis. All of these signals share a common theme. The system is functioning, but only through continuous intervention and support. Remove the interventions, and dislocations appear immediately. This is not stability. This is managed instability. And the longer it persists, the more dependent the system becomes on the interventions, and the less capable it becomes of functioning independently. History does not provide a roadmap for what happens when a global reserve fiat currency loses credibility, because it has never happened before. The Roman denarius collapsed, but Rome was not a global economy. The Chinese jiaozi failed, but it was not a reserve currency. The German Reichsmark hyperinflated, but Germany was a regional power recovering from defeat. The US dollar is different in scale and systemic importance. Its potential failure carries consequences for which there are no historical precedents. But history does tell us what happens when fiat currencies fail at smaller scales, and those patterns are instructive. The first consequence is the breakdown of trade. When merchants cannot trust that the currency they receive today will hold value tomorrow, they stop accepting it. In Zimbabwe, in the 2000s, the official currency became so worthless that transactions shifted to US dollars, South African rand, and barter. Shops posted prices in foreign currencies. Salaries were paid in foreign currency when possible. The Zimbabwe dollar remained in circulation, but only because the government legally required its acceptance. Its economic function had ceased. In Argentina, which has experienced multiple currency crises, the population has learned to dollarize savings immediately upon receiving pesos. This prevents wealth accumulation in the domestic currency and forces the government to either allow dollarization officially or impose capital controls to prevent it. Capital controls, in turn, create black markets where the real exchange rate diverges dramatically from the official rate, in Argentina's case, often by 50 to 100%. The second consequence is the destruction of savings. Middle-class populations that stored wealth in bank deposits, bonds, or pension funds discover that decades of savings have lost most of their value. This is not a gradual process that allows adjustment. It accelerates. Once currency depreciation begins, it feeds on itself as people rush to convert to hard assets, driving prices higher, which validates the decision to convert, which accelerates the rush. In Turkey, where the lira has lost over 80% of its value in recent years, the population has shifted to holding dollars, euros, or gold. Real estate prices are often quoted in dollars even for domestic transactions. This is a population adapting to currency failure in real time. The official currency still exists. The government still issues it. But its function as a store of value has been destroyed. The third consequence is fiscal collapse. When currency depreciates, government revenues collapse in real terms. A government collecting taxes in a depreciating currency finds that by the time the taxes are collected and spent, they have lost significant purchasing power. This forces governments into a choice: cut spending dramatically, raise taxes to confiscatory levels, or print more money to cover the gap. Each option creates political instability. The typical choice is to print, which accelerates the currency's decline. The fourth consequence is political upheaval. Currency collapse is not primarily an economic event. It is a trust event. When populations realize that the government cannot or will not maintain the value of the currency, trust in government institutions more broadly collapses. This manifests in protests, strikes, political extremism, and sometimes regime change. The Weimar hyperinflation that destroyed the German mark in 1923 created the political conditions that brought the Nazi Party to power a decade later. The hyperinflation of the 1970s in Latin America destabilized democracies and led to military coups. The collapse of the Soviet ruble in the 1990s created oligarchic kleptocracy. Currency failure and political failure are intimately connected. For the United States and the dollar, the consequences would be amplified by the dollar's role as the global reserve currency. Trillions of dollars sit in foreign central bank reserves. Trillions more in private accounts overseas. Commodities are priced in dollars. Debt is denominated in dollars. If confidence in the dollar were to break, the rush to exit dollar holdings would be unprecedented in scale. Where would that capital go? There is no currency large enough to absorb it. The Eurozone is economically stagnant and politically fragmented. The Chinese yuan is not freely convertible and is controlled by an authoritarian state. The Japanese yen is backed by the most indebted government in the developed world. Gold and silver are options, but their markets are too small to absorb trillions in flows without prices rising by orders of magnitude. The most likely scenario is not a single dramatic collapse, but a gradual loss of confidence that manifests as persistent inflation, currency volatility, and increasing financial repression. Capital controls to prevent outflows, negative real interest rates to inflate away debt, forced purchases of government bonds by banks and pension funds. These are the tools governments use when they have lost market confidence but retain political power. This is already occurring in various degrees across the world. China has capital controls. Europe has negative rates despite inflation. The United States is pressuring banks to hold more treasuries through regulatory requirements. These are not temporary emergency measures. They are structural adaptations to a system operating beyond its sustainable limits. The final historical lesson is this: no fiat currency has survived indefinitely. The longest-lived fiat currencies have lasted roughly a century before being replaced or reformed. The US dollar has been a pure fiat currency for 54 years. The global fiat system is now in its 6th decade. If history is any guide, we are not at the beginning of this experiment. We are in its late stages. The gold standard did not collapse because it was inferior to fiat currency. It collapsed because governments chose to break it rather than accept the fiscal discipline it imposed. The fiat system that replaced it has now created imbalances larger than any gold standard could have sustained. Total global debt, government, corporate, and household, exceeds $300 trillion. Global GDP is roughly $100 trillion. The world is carrying $3 of debt for every dollar of annual economic output. Under a gold standard, this would have been mathematically impossible. Under fiat currency, it is merely unsustainable. The central banks buying gold understand this. The investors accumulating silver understand this. The populations in Turkey, Argentina, and Lebanon living through currency failure in real time understand this. What remains unclear is whether this understanding will spread before or after the consequences become undeniable. History does not repeat, but it rhymes. And the rhythm now is eerily familiar to anyone who has studied how money systems fail. The debasement of Rome, the paper currency experiments of China, the hyperinflations of Germany and Zimbabwe. The pattern is always the same. Expand the money supply to address immediate needs, defer the consequences, expand further to address the consequences of the first expansion, and continue until the currency loses credibility and the system resets. We are not at the reset yet, but the mathematics that make it inevitable are already visible. And mathematics, unlike politics, cannot be negotiated with or voted away. This is not prediction, this is pattern recognition, and the pattern has never resolved peacefully.